If you trade on the 1 hour time frame and you want to know how to predict the markets more consistently, then this video is for you, because I'm going to share with you my 3 main principles to predict the market consistently and predictably. Now, I do have to warn you, by the end of today, you're going to have everything you need to predict the markets and you're going to be tempted to overtrade. Now, with that being said, let's get straight into it. So there's 3 main principles, like I said. The first principle that you have to understand is that the market, honestly, it moves in waves. All we simply have to do is we have to time our entries and our exits based off of like the bottom and the tops of the waves. I'm gonna show you exactly how to do that now. You will also notice at price, when it's about to pull back, the market will actually slow down and give you a lot of hints that it's going to slow down. This right here is a trade on Euro CAD, and I was able to exit out right around here. Now I did exit out a bit early, but even if I would have exited out up here, the pattern is the same. Notice how the market starts to kind of consolidate a bit and to slow down right before it's preparing to make a move in the opposite direction. So just make it a habit that whenever you have a trade running in profit, you're approaching close to your profit target, and then you see that the market actually starts to slow down, just know that the market is telling you that that's a good place to exit the trade because it's probably about to pull back. Now, unless you're looking for a bigger move, which I sometimes do, and just anticipating that the market's going to continue to go bullish, then I'm not gonna exit right here. I'm not gonna exit after it pulls back. I may as well just exit at the top and not have to basically diminish some of my profits just due to the pullback. So, I mean, that's pretty basic, but another really important thing here, guys, is looking at those higher lows and those higher highs, because that on the 1 hour time frame alone is already gonna tell me where the market is going with an 80% certainty. Right here, let's just say we're only looking at market structure, right? We have this low, this high up here, and then we have a higher low and a higher high. Where did the market go off of here? Well, all it simply did was it made a pullback, the bottom of the wave, and then the market predictably moves in these waves. And basically, you know that the wave is about to be over once the market first slows down. That could be the pullback. But once you actually start to break lows, you break this previous higher low, that's when it's confirmation that now we're not going bullish anymore and the market is turning into a bearish market. So right here, let's say you enter in a buy here at the bottom of the wave, you exit right at the top when it starts to slow down, you're good. If you're looking for another buy position, all you simply have to do is find that higher low, wait for price to show you some type of confirmation, and then you enter in. Right here, you have no confirmation, so the market just shifts trend. Even if we just go to the trade that I got into this week and I made $14,000 on this trade right here, you can see even though it almost looks a little bit choppy, it's not. What I did here was identify the wave of the market, and notice after that wave up, of course, the market had to pull back into this area of support. I noticed that the market going down was actually extremely slow. So it was so slow that I was like, I'm going to enter in here because I know based off of my experience and based off of what I'm seeing here, that this is gonna be the bottom of the wave. And once you guys start applying this, it's very simple because you enter at the bottom of the wave. So if the market goes down further, then all of a sudden it's not the bottom anymore. But look at that risk to reward. You're only risking what? Let's say 20 pips, but you're looking to make potentially up to even 100 pips in some cases. And then you just simply exit once the market shows you signs of slowing down. Yeah, sometimes it'll backfire a bit, like right here. Like for example, I closed slightly early because it started to slow down before my take profit. But all in all, I still caught a 1 to 2 risk to reward. So I'm still very happy with this trade. But now let's talk about where traders mess up, because honestly, a lot of traders might understand this concept and they might have heard, okay, the market moves in waves, so all we simply have to do is just ride the wave of the market and we'll be good. Yes, but every single move that the market makes is a wave. That's not necessarily true. And I'm gonna show you some examples of when the market moves, but it doesn't actually make a wave. For example, first of all, down here, I think this is an example, although you could have still caught this buy position based off of that, this was not making waves. The first one is that notice how there's no clear trend. The fact that there's no clear trend simply tells me, look, at the end of the day, there's no trend here. There's no trend, there's no waves. The waves are just inside of a consolidation. That's not what we're looking for whatsoever. Second of all, this big move that happened right here was due to a news event. So all it simply means is that the market was consolidating before a high impact news, and then the market moved bullish. Since we are looking at the 1 hour chart here, we have to keep in mind news. Sometimes it will affect it, but it's pretty simple. When the market is clearly not showing you a direction, like right here, this is not the market showing you where it's gonna go. It's just consolidating. So what you have to do is you have to wait for it to break out and then try to find the trend. Something like this is an example of when the market is making waves because it's pretty predictable. It moves up, comes down, goes back up, and that's where most of the money is made. That's where 90% of my money is made in these predictable movements like this one. A lot of people didn't understand why I took this trade, but for me, it was so obvious. A lot of traders also chase early entries before they get confirmed. So this is a big mistake. What you have to do is you have to wait for 2 higher lows to get formed before entering in on the trade. A very, very good example of this. First, let me draw it so you understand. Let's say you have a bearish market, and then let's switch this to green. Now let's say the market starts to go bullish right here. Are you going to enter in off of this higher low because this low is higher than this one? The answer is no. You're not going to enter in at this higher low. You're going to wait for it to make the second higher low before entering long. And then you can enter long and catch the entire movement up. This will work 80% of the time, while this one will work maybe 50 or 60% of the time. Trust me, you want to wait for that second higher low to get formed. An example of this in the market, let's see if I can find it. I mean, if we use this example, this one was mostly just consolidating, so I'm not going to use that one, but let's say we use this one. You have the major low down here, then you have the first higher low. Could you enter here based off of the rules? No. You're going to enter in off of here because the probability of it being a bullish trend is much higher at this point than it is at this point. Now, maybe this isn't the best example because you could go ahead and say that this was a higher low and then this was the next one. All in all, wait for multiple higher lows to get formed before just immediately thinking that the market is bullish or bearish, you know? Let's say on the opposite. Let's say we have a bullish market and you want to sell it. The market makes its first lower high. Are you going to sell it right there? I wouldn't recommend that because the market could simply just be doing a deeper pullback before the movement bullish. So that's a very, very simple concept to understand, but it's important to remember. Timing is everything. And what I mean by timing is everything is 2 main things. First of all, if you wait for the impulsive move, then you're already too late. Second thing is that you want to use the wicks to show you when it's the right time to enter the trade. Because when price starts to reject and you have those wicks showing you, that's when you want to enter in. If you wait for the wicks, let's say this right here is a perfect example, what we have right next to here, right next to this trade that I took. You have a big wick rejection, right? Let's say you're going to enter. The right time to enter is upon this candle closing. If you wait for the impulsive move, which is this one, then you're already too late. Because now in order for this to have a positive risk to reward, which is at least a 2.4, the market would have to come all the way up here. And honestly, chances are that the market is actually going to come down, hit your stop loss to make a deeper pullback before that full move to the upside. So if you want to avoid all of those problems, then just make sure you have your timing done right. Now let me show you an example of where the timing was correct. In my trade that I took this week, the timing was correct. And the reason for that is because I waited for the market to show me that it was rejecting. The market was very slow on this pullback. That's how I know that the market is simply just pulling back before the next impulsive move to the upside. I want you guys to realize, look how much bullish pressure we had when the market moved above resistance. And look how little bearish pressure there is when the market was pulling back into support. Very little. So as soon as I start seeing this one candle, which this ties in perfectly to the second principle, which is related to intuition and momentum, I knew it was the right time to enter. Timing, timing, timing. You always want to make sure you're entering in at the bottom of a wave. That's why I always say, make sure you know what phase of the market are you in. Are you in a higher low? Are you in a higher high? Or are you in a lower low or lower high? Because if you're somewhere in between, let's say you're right here, you're right in between the higher low or the higher high, then that's where you need to avoid trading. You cannot trade in the middle of a higher low and a higher high. And most of the time, the market is literally in between those points. So if you miss your entry, if you miss the higher low, the bottom of the wave, don't enter the trade because there's literally no entry confirmation. And then if you try to enter up here, your risk to reward gets messed up so bad that you shouldn't even take the trade anymore. It just doesn't make sense. The timing comes from the entry, and you need to understand what phase you're in. Are you in the higher low? Are you in the higher high? The second pillar that you're going to use to predict the 1 hour chart, intuition that you get from watching the charts and from overall chart time, is gonna help you predict the 1 hour chart more than a lot of other factors. Because let's say you've seen this exact move happen countless times where the market will pull back right into an area of resistance. And not only is it pulling back, but remember the concept that I explained earlier where it's the second higher low, not the first higher low. All you simply have to do is wait for some type of rejection. You enter in off of this candle, stop loss below, take profit up here, and you reach your 2.3 risk to reward. How simple can this strategy really be? That is all it is that you're looking for, because notice here, this market was a bearish trending market making lower lows and lower highs. Very simple. It was moving in waves, up, down, very consistent and predictable waves. Now, what happens up here? It comes up and breaks the previous lower high. In order to confirm that we may be bullish, we make a higher low. Do we enter in off of the first higher low? No. Our rules say that we enter in off of the second higher low. Boom, retrace, pulls back into support that has previously been used as resistance, and then the market goes bullish into the next area of resistance. This is how you want to basically look at the markets, and by looking at the 1 hour chart every single day, that's how you're going to start to build that intuition. And honestly, you'll be able to see the markets automatically. You won't have to think about this. You'll just know where the market's going to go most of the time. So in order to get this intuition, practice every single day on the 1 hour chart on at least 5 different pairs. If you can do your analysis on 5 different pairs every single day, you're literally going to have market structure down to a T after doing this for 30 days. Because you're going to be able to spot fake outs, you're going to spot reversals, and you'll be able to spot market structure easily. This is crucial, and I think this is one of the main reasons why I've been getting so good at just simply knowing where the 1 hour time frame is going to go. When the market does a breakout, you have to know if it's strong breakout or if it's a weak breakout. And honestly, intuition that you're going to get from watching the 1 hour chart every day is going to give you that, because you'll know when the market is simply doing a fake out or when it's actually breaking out. Like for example, this right here is an actual breakout that then led to a huge movement to the upside. But then I can show you an example of a fake breakout where we can easily just tell like, okay, there's no momentum. This is a perfect example right here. This is an area of resistance. It almost looked like the market was about to break out, but notice the next candle immediately left a big rejection to the top side. So where's the market going to go? It's not going to continue to go bullish. That's a false breakout. It's a weak breakout. As well as this one. I mean, this one broke out, but then it came back down. It was kind of like a fake breakout. And you could tell because this was over the weekend, there was not a lot of momentum. And you have to take all factors into consideration. It's very, very simple. I mean, at the end of the day, is there momentum here to continue bullish? Not really. Until the start of the week, and then there was momentum. This is a good example right here. The market made it seem like this was the breakout, but then it came back down before going up and then back down again, consolidation, and then we got the breakout. You could have still caught this bullish move up, but I'm saying that this first breakout right here was just so weak that there was no point in trading it. Having the intuition to wait for the right trade. Because honestly, most traders come to the markets and they are looking for a trade. They're looking for a setup and they end up forcing a trade because they want to find a position. Once you get the right type of intuition, you'll wait, even if it's days, for the right setup. This is what I do every single week. If you guys follow me anywhere, you'll know that I'm not taking 5 trades a week. I'm not taking 10 trades a week, 15 trades. I'm only taking about 1, 2, sometimes 3 trades per week. And it means that sometimes in between those trades, I'll have to wait a couple of days for the right setup, because I understand very well that I can risk 5x, 10x as much on an A plus setup as I can on a B plus setup. It's exponential. If the A plus setup makes me a certain amount of money, let's say it's 70%, 70% win rate, and the B plus setup only makes me a 55% win rate, I would much rather take that 70% trade, because it's gonna play out so much more in the long run. So in the short term, sure, you might make more money if you win 3 trades at a 55%, but you win only 1 trade at a 70. But in the long run, you're gonna want to only take your high risk on those great setups. That's why I'm able to risk sometimes even up to $10,000 per trade, just due to the fact that I'm so confident on the setup. And that's gonna come with chart time and by doing the practice every single day. And now for the most important part about this whole entire video, the part that I've been saving for last, because honestly, this is my favorite part. Getting the daily bias is literally how you know where the market's gonna go. So this is by far one of the most important things that you need to have down before you enter in your trade. And what I mean by that is, if you don't check the daily time frame before you enter in, then by the time you check the daily, first of all, you're gonna be biased to think that it is in your favor. And second of all, you're not gonna have a good target for where to place your take profits. I love looking at the daily time frame to anticipate, where the market's gonna go, how it's gonna form, and how it's gonna set up. Super important thing to understand is that the 1 hour time frame and the daily time frame, they actually work together perfectly. A lot of people seem to think that, no, you have to look at the 1 hour and the 4 hour. I look at the 4 hour a lot, but in this case, the daily time frame is one of my biggest predictors about where the 1 hour is gonna go. Specifically, the current daily candle is my green light, because it literally tells me where it's gonna go. Now, let me show you an example of this. Right here, this is GBP AUD. This is the 1 hour chart. You see how we made this bullish move up here? Look at the daily time frame. We came to a major area of support on the daily time frame, and look how many daily wicks we have formed to the bottom side, not to the top. Notice how the wicks to the top are very small, but the wicks to the bottom are massive. This is something that cannot go unnoticed in your trading, because it tells you where the market's gonna go. I mean, it's pretty simple. And then look here, if you go down to the 1 hour time frame, okay, so now we're at the daily support. We have rejections. Every single time the market reaches the bottom, it just rejects and goes upwards. As you see, this right here is a setup. A lot of setups can be taken just by looking at the direction of where the daily is going. So what does this mean for your trading? If you're looking to take a buy position, the current daily candle, it needs to be bullish. The mistake that 95% of traders make, literally so many traders who are DMing me and asking me questions about their trading, they're taking the trades based off of the daily trend. One of the most common questions I get is, oh, is this setup good? Or does this setup match the ride the wave strategy? I want to make this video for you guys who are asking me them, taking trades based off of the daily trend instead of where the daily candle is going. Instead, look at what's more important, where the current daily candle is printing. Because if you're looking at the daily trend, but you're taking a trade on the 1 hour time frame, at some point it does start to become irrelevant. Someone asked me today about the weekly time frame. Honestly, the weekly time frame, am I really going to use the weekly time frame for a trade that I'm planning to only be in for a couple of hours or potentially 1 or 2 days? No, not necessarily. We're swing trading, but we're not using the weekly for most of the trades, especially when I'm here doing my analysis and predicting where the 1 hour chart is going to go. It just doesn't make sense. And when you go to the daily, don't just zoom out and look at the overall trend about where we've been going for the past couple of months. Because if you notice here, this is a bullish trend. This is since 2024. So this is what, an 18-month trend? Sure, that matters to some extent, but really it doesn't matter. It just doesn't matter. the information does become irrelevant at some point. So I love looking at where the current daily candle is starting to form and where the last previous couple of candles have been forming. In this case, the past couple of candles weren't bullish. I mean, that's partly why I did not take a buy position on GBP AUD. But if I was looking to buy, at least I would be able to look at the fact that the previous candles were at least massively rejecting this daily support, which also happens to be a psychological level at 2.05. So notice how we have so many confluences, so many confirmations about why the market should go bullish there. Now that you understand that it's more important what the current candle is printing, next let's talk about support and resistance. Because if you get a support bounce or a resistance bounce on the daily confirmation, the market will continue to move in that same direction at least 75% of the times. This is from my experience what I've seen. If you're at a daily area of support and you actually get some confirmations that it's reacting to it, most of the time the market actually is going to respect it. Don't automatically buy if the market reaches that daily support, but watch for hints. Look for a hint. Because if you can look for a hint when the market is at a daily level, whether it's support if you're looking to buy or resistance if you're looking to sell, and then you start to see a couple of different factors like rejections, a lot of wicks. If you go down on the 1 hour chart and you see bullish confirmation or bullish market structure, sometimes you'll be able to see something like this. Let's say you're at a daily support and then you start to see this, but then all of this is the daily support. You can start to look for buy positions at this area using the 1 hour market structure, but the daily bias. That's why it's so important to have a daily bias. So if you have your daily bias, you have your bounce, it's literally gonna work most of the time. It's gonna work 75% of the time if the market bounces off of a clean level. And what I mean by clean level is an important key level like 2.05 on GBP AUD. And lastly, the wicks show you the direction. I love looking at the wicks when I'm looking at the markets, especially on the daily bias, because if I'm looking at the daily bias and we have a lot of wicks to one direction, the market's gonna go there. Look at how often this plays out. Let's investigate on the daily time frame. Look, every single time the market makes a lot of wicks. Let's say right here, the market made 2 wicks, big ones, and then it went bullish. Then it tried coming down again, left wicks to the downside, and then we went bullish again. We formed daily support here, a lot of wicks, and then we went bullish. Right before making bearish wicks, wicks to the top side before the market comes down. Well, right here, this was a lot of news going on and stuff, but the market still rejected the downside, tried to go bullish, then left a lot of wicks to the top side. Obviously, this is where it becomes hard to trade, but you still see that the market loves to respect these wicks. Right here, what is the number one sign that the market was gonna make that move down? Boom, right there, right in the middle of the circle. It doesn't fail, it doesn't fail. Look at this. I mean, I think you guys get the point. Look at how many times this plays out. All you have to do is just look at the screen right now and just follow along with what I'm circling, because these are honestly the hints. This is what I've done for hours and hours and hours on end, and this is how I'm able to understand the market so well. And this is how I'm able to time my entries to the bottom of a wave if I'm buying, to the top of a wave if I'm selling, and that's how I'm able to be more accurate in my trades. Because a lot of the times, honestly guys, if I'm about to take an entry, I ask myself, do we have a wick rejection in my favor? If we don't, that's -1. A break and retest with the wick rejections, that's +1. I'm keeping count in my head of all of these factors. So when I enter in my trades, I have the highest chance of winning. Because at the end of the day, I'm risking $10,000 on a trade, $8,000 on a trade. I want to make sure that I have the highest possibility of winning that trade. Let me circle a couple of more examples. Notice here, the market rejected the downside and wasn't able to immediately go bullish. It actually came down one more time before going bullish. Of course, you can't just trade based off of a wick alone, or you actually probably could, but to make this strategy as profitable as possible, you want to combine it with all of these other things that I've taught you. Look at this massive wick down here. It doesn't even fit in the screen because of how freaking big it is. That caused the market to go bullish. This caused the market to go bullish. This is probably one of the most underrated things that you can find in trading to tell you where the market's going to go. I truly think that looking at wicks is probably one of the most underrated things that literally no one talks about. I don't know why, but I'm telling you, I made a lot of money from these wicks. So if you're looking to buy, you're looking for a buy position on the 1 hour chart, and the daily candle is rejecting the lows with a wick rejection, that's a strong signal. Ideally, the wick on the bottom is larger than the wick to the top. So let's say this is the wick to the bottom, this is the candle, and then it makes like a slight little wick to the top. This wick right here is the one that wins, and the market's most likely gonna go bullish. I know that was a horrible drawing, but you guys get the idea from all the examples I showed you. Last thing, you need to avoid taking the trades when the daily candle is forming a large wick against you. I would never buy on a bullish daily candle if there's a huge top wick and the wick to the bottom isn't just as big, or if not bigger. So forget about that. If you're trying to buy on a candle, let me find one. Let me just find, there you go. Trying to buy on this candle is just not accepted by the rules. Yeah, maybe you would have gotten lucky here and the market went bullish, but trust me, you're gonna wanna follow this rule. If you try to buy the market on a daily candle with that situation going on, you're gonna lose a lot of the times. And yeah, you are seeing some examples here of it playing out, but let's say right here, let's say you buy on this one. On this one, you have a much bigger wick to the top side than you do to the downside. What happens? That was actually the high of the market before it goes down hundreds of pips. This right here is a movement of 300 pips because it's a daily time frame. Make sure when you're trading, it looks good on the daily. So at this point, you guys know how to predict the markets much better than you did before. Leave a comment with what you want to see next, and make sure to watch this video right here in order to fully lock in the strategy and what ride the wave means with all the details included. So I'll see you there. Take care.